The S&P 500 rebounded today after last week's market sell-off, closing the early morning gap to end the day above the 100-day moving average. Bonds continue to sell off. The 10-year Treasury was up 2 basis points, grazing its highest level since late 2023. The 30-year was up 1 basis point, touched the 5% mark intraday for the first time in more than a year. And the 1 year is at 4.24%, which incidentally is the forward yield estimates for the S&P 500 as for December 31st, end of the year. Later this week, I guess tomorrow we have the PPI, Wednesday we have CPI, and JP Morgan also kicks off earnings season Wednesday. And what does all of this really mean? Find out now in this week's Hillbilly Breakdown. Welcome to another episode of the Hillbilly Economist, where we weed through the latest market news and economic data so you can stay savvy when the market hears banjos. If you're new here, be sure to like, share, and subscribe. So, why bonds? Obviously, you cannot trade the stock market if you don't know what the bond market is doing. Now, treasuries offer a filter to gauge economic growth. Risk aversion, inflation, you can gauge market sentiment. Since bond prices move opposite to interest rates, it often shows where the market thinks rates are going to go. And higher bond yields can signal inflation worries. So what happened this week to cause the market sell-off? Well, it comes back to those inflation worries. Also, we had jobs reports released. Now, that matters. A strong job market generally leads to stronger economic growth. Before we get into all the numbers, we need to take a look at how they all fit together. The GDP is the total value of all final goods and services a country produces domestically within a specific period of time. Usually it's judged by the quarter. It's made up of a few components. Consumption represents private spending by households on goods and services. It's the largest part of GDP in most economies. It's made up of things like durable goods that last 3 or more years. These are your vehicles and furnitures, appliances. Your non-durable goods, items you use up quickly, food, clothes, gasolines, and it includes services like haircuts and mechanic work, and doctors, etc. The I part is the investment category, and this includes spending on capital goods, as the goods used to produce other goods. Businesses investments. This is spending by businesses on things like machinery, equipment, and factories. It could also be residential, including new home buildings and renovations. The G is government spending, and this is all spending by all levels of the government, federal, state, and local. The only things that these do not include are transfer payments like Social Security, unemployment benefits, because these don't represent a direct purchases of goods and services. And the NX is the net exports. This is your surplus or deficit ratio. This is the difference between a country's exports and imports. And that's a really good indicator of growth as well. So in essence, the GDP is a performance indicator, and it adds up all the spending in the economy, what consumers spend, what businesses invest, what the government spend, what the net effect of international trade is. All of this compiled into one can give you a really good indication of a country's economic health. Okay, so let's go back to the jobs report. We got Friday, we got unemployment, we got JOLTS, and we got non-farm payrolls. Unemployment rate, 4.1%. Unchanged. We actually added some jobs, but the rate itself has not changed that much. Let's see, high unemployment, the fewer people working means less production of goods and services, and this directly reduces your GDP. It also leads to lower consumer spending because unemployed people have less income. Now, what the unemployment rate measures is the number of people in the labor force that are looking for a job but can't find one. It also gives you the percentage of the labor force that's participating. Now, low unemployment means people are working, higher production, and increase in consumer spending, contributing to the GDP, but very low unemployment can lead to labor shortages and wage pressures and possibly inflation. The JOLTS is job openings and labor turnover surveys, is job openings, hires, and total separations. This report is data on job openings. We got hires, quits, layoffs, and other labor market flows. Gives a dynamic view of the labor market more than just the unemployment rate. For instance, if you look at job openings, a high number of job openings suggests a strong demand for labor, which can lead to increased hiring and ultimately higher production of goods and spending. More hires obviously translates to more people working and earning wages, increasing consumer spending. Quits quits are a little tricky. Usually they represent, if you have a high number of quits, it represents consumer or worker confidence because people aren't afraid to lose their job going to look for a new job. But it can also lead to wage increases as companies compete for workers. The higher wages can fuel consumer spending and GDP growth, but also leads to inflation. The layoffs, a high layoff, are a sign of economic weaknesses. If you get rising layoffs, businesses are cutting back on production and reducing their workforce. This leads to lower consumer spending and can negatively impact your GDP. What we have now, though, what's cool here is the non-farm payrolls. Non-farm payrolls is a monthly report on the number of jobs added or lost in the U.S., excluding farm workers, government, military, nonprofit organization, private household workers, things like that. It's strictly civilian, non-institutional population. Now, positive non-farm payrolls indicate job growth, increasing production, consumer spending, and overall economic activity. This is where the real job hires are coming from the private sector. A negative non-farm payroll indicate job losses, decreases in production, and potential economic contraction. The total non-farm payroll employment rose by 256,000 in December. Employment trended up in health care, government, and social assistance. That 256,000 is their revised number. It's not there on their chart, but it's actually up here in their revised statements. This is all from the Bureau of Labor Statistics, by the way. I'll leave the links in the comment section below. So, tomorrow we have the beginning of inflation data pouring in. The PPI. Now, the PPI is basically inflation from the seller's perspective. It measures price changes before they reach consumers at the wholesale level, the producer's level. The PPI actually, it can help track inflation pressures building up in the economy and be a leading indicator of consumer inflation, our inflation, because rising producer prices will often get passed on to us, the consumer. So, November's headline PPI looks like year over year is December's PPI is supposed to rise to 3.4%, I think, are the revised projections, and the core PPI to rise to 3.7% year over year. And we can see that the core percent year over year was 3.1% last November, and the headline was at 3%. It rose 4% month over month and 0.7% month over month for the core CPI. Tomorrow, or not tomorrow, but Wednesday is the CPI. The CPI index tracks how much more or less consumers are paying for the same stuff over time, everyday goods and services. It just tracks the change in the price of our goods. It's a key indicator of inflation because of this, and it affects things like the cost of living adjustments, social security payments, and monetary policy decisions. The CPI is to be released Wednesday, and the expectation last month was for a 2.7% year over year headline inflation rate and a 3.3% year over year core inflation rate. In November, the core CPI actually rose 3.3% above expected, while it was the largest increase since April. Now, these affect GDP consumer price index affects GDP directly into the consumption category. CPI, the prices that we pay for goods and services, the largest component of the GDP, a rise in CPI can reduce our purchasing power, potentially leading to decreased spending and slower GDP growth. But a stable CPI can support healthy GDP growth. In some, inflation is good for the economy. A certain percentage of inflation is good because it is a fuel for that growth. Indirectly, they affect monetary policy. The Federal Reserve uses CPI as a key indicator when deciding interest rates. A high CPI usually makes the Fed want to raise rates and combat inflation, while higher interest rates can slow economic activity, potentially impacting the investment category and overall GDP growth. Now, while CPI has a more direct impact on consumer and government spending, the PPI can provide early warning signs about future inflation and the potential impact of business investment and international trade. The Federal Reserve uses the combination of unemployment and inflation data to make decisions on monetary policy. It's their dual mandate to promote maximum employment and stable prices. So when you see high unemployment, the Fed tends to pursue expansionary monetary policies. This could involve lowering interest rates, increasing the money supply. The goal is to stimulate economic activity by giving people more money in circulation to spend with and encourage businesses to hire more workers and reduce the unemployment. But that also leads to high inflation. And when the inflation is high, the Fed tends to pursue contractionary monetary policies and cut or raise interest rates and decrease the money supply. So the goal there is to reduce the demand for goods and services and bring inflation back down to a desirable level. When we talk a lot about interest rates and why they're important, because the central banks use interest rates as a tool to control and manage inflation. They use it to leverage inflation. And essentially, it is the price of money. They represent the cost to borrow money and the return on that money borrowed. And they directly impact the cost of individual loans, mortgages, car loans, business investment expansions, and they influence the return on your savings accounts and bonds, other investments. The interest rates influence the GDP in a lot of ways. They make borrowing cheaper if you lower the interest rates, and this can encourage spending on big ticket items, your durable goods, cars, things like that, while higher interest rates make borrowing more expensive, discouraging spending. Reduce the cost of borrowing for businesses at lower interest rates and increase the cost of borrowing at higher interest rates. It makes investments less attractive or potentially delaying or canceling projects, and this can decrease investments in capital expenditures for the investment categories. It could also increase or affect your net exports. Higher interest rates can attract foreign investment, increasing the demand for domestic currency and causing it to appreciate. So, playing with the interest rates and exchange rates can really mess with the net exports and the overall impact on GDP. Lowering interest rates stimulates the economy by activating by encouraging borrowing and spending and investing. Now, the problem with GDP as an economic indicator is that GDP growth can be artificially inflated. And certain factors that don't necessarily reflect genuine economic well being, like government spending and debt fueled consumption, while government spending is a part of the GDP equation and it does contribute to it, excessive spending or inefficient allocation of funds is a misleading picture of economic health. And if unsustainable debt levels drive GDP growth, it's not a sign of a healthy economy. Actually, the COVID-19 pandemic exposed a lot of the limitations of GDP as an economic indicator. It couldn't account for shifts in consumption patterns, increased online shoppings, decreased in person services, the changes in the quality of goods and services, employment down, government spending up. We had a highly inflated GDP, but our economy was in the garbage. So, as mentioned earlier, government spending is a part of GDP, but it can be problematic. Government spending may not always be efficient or lead to productive outcomes, and excessive government borrowing can drive up interest rates too, and it crowds out the private sector's investments. A good example of artificially inflated GDP would be China, and you can look that up and do your own research. That's a topic for another video, though. So, how do you determine if a high GDP is a false signal? Well, you assess the other components of the equation. Analyze what's driving the growth. Is it broad based consumption, investment, net exports, or is it concentrated in specific sectors? Look at unemployment, inflation, productivity, income inequality, even to get a more complete picture. High levels of public debt and private debt can signal unsustainable growth as well. Trade deficits. I do have to point out, though, a trade deficit can signal a strong domestic investment and consumption, fueling future economic growth. Even though it's a deficit, it's not always a sign of a weak economy. So, to wrap this up, we have later this month the PCE, which is the Personal Consumption Expenditures Price Index. It's a measure of how much people in the US are spending on goods and services. If you want to think of it as kind of a snapshot of consumer spending at a particular period of time, it's a massive part of the US economy. The PCE tracks inflation or deflation. It shows how the prices are changing for the things that we buy. And the Federal Reserve actually prefers to use the PCE when making decisions about monetary policy. In simple terms, it tells us how much Americans are spending and how the prices are changing for those same goods and services. And the Personal Consumption Expenditures Price Index increased 1.5% in the third quarter, meeting estimates, and that was unchanged. So putting all these numbers together, we had the real GDP growth. It rose 3.1% in the third quarter. At an annual rate, it's primarily reflected by accelerations in exports and federal government spending, with slight bumps in consumer spending. And we have our trade deficit. You see, our deficit actually widened by 6.2%. Even though our exports increased by 2.7%, our imports surpassed that at 3.4%, negating that gain in the exports. So we've widened our trade deficit there. Now, we've looked at a lot of numbers today. The S&P's rallying, Treasury yields are climbing higher, a strong jobs report, GDP is chugging along, and inflation is still clinging to us like gorilla glue. So what's the real story here? It's a bit of a mixed bag. It's like a potluck where some brought the good stuff and others, let's say they tried. On the one hand, the economy isn't exactly sitting still. We're seeing job growth. People are spending money and businesses are doing their thing, and that's good. But on the other hand, prices are staying high. The bond market signals investors are worried about hotter inflation data and a cold Fed decision, and probably some less than impressive earnings. But the big question is, what's the Fed going to do about it? They're stuck between a rock and a hard place trying to keep prices stable without throwing the whole economy in a ditch. PPI and CPI will help us with the picture. So, looking forward to tomorrow. Anyway, that's your hillbilly breakdown for this week. We'll keep weeding through the numbers so you don't have to. And as always, don't forget to like, share, and subscribe, and keep the banjos playing.